To understand the change in the market through a graph, you need to look at the price movement of a stock or index over a period of time. The graph visually shows you how the price is changing, and it helps you understand trends and patterns. Here's a simple explanation of how to read a stock market graph and identify key changes. 1. Basic structure of a stock market graph. X-axis, horizontal axis, represents time, such as minutes, hours, days, weeks, or even years. Y-axis, vertical axis, represents the price of the stock or market index, like in rupees or USD. Line or candlesticks. The graph shows the price movement using either a line graph or candlestick chart. Example of a line graph. A line graph will show the stock price as a continuous line that moves up and down over time. Example: the line goes up from 100 rupees to 120 rupees, meaning the stock price has increased. Example of a candlestick chart. A candlestick chart shows the opening, closing, highest and lowest prices during a specific period, like 1 hour or 1 day. Green or white candlestick indicates that the stock's closing price is higher than the opening price, showing an increase. Red or black candlestick indicates that the stock's closing price is lower than the opening price, showing a decrease. 2. What you can understand from the graph. Trend. A trend is the general direction the stock price is moving over time. It can be uptrend, when the price is moving higher over time, a rising line on the graph. Downtrend, when the price is moving lower over time, a falling line on the graph. Sideways, flat, when the price stays within a range without significant movement in either direction, a horizontal line or flat line. Example: uptrend. The stock price goes from 100 rupees to 150 rupees over a few weeks. You see the graph line moving upward, which means the market is in a bullish trend, positive growth. Downtrend. The stock price goes from 200 rupees to 150 rupees. The graph line is moving down, indicating a bearish trend, negative growth. Sideways. The stock price stays around 50 rupees for months, with minor fluctuations. This means the market is not moving much and is stable. Identifying market changes. Price spikes. Sometimes the graph shows sudden spikes where the price moves sharply up or down. This can indicate important news or a significant event that has impacted the market. Example: the price suddenly rises from 200 rupees to 250 rupees in 1 day. This might happen due to positive company news or a strong earnings report. Volume, bar graph below the price line. Volume is shown as bars under the price graph and represents how much trading has taken place, how many shares were bought, sold. High volume. If the volume bar is tall, it means many shares were traded, indicating high interest and potentially significant price moves. Low volume. If the volume bar is short, it means fewer shares were traded, indicating less interest and slower price movements. Example of market change. Imagine you are looking at the graph of a company's stock for the last month. 1. Start of the month. The stock price is at 100 rupees, and it gradually rises to 120 rupees over the first week. This shows an uptrend. Second mid-month. The stock price suddenly spikes to 150 rupees due to good news about the company's earnings. The volume is also high, showing strong investor interest. Third end of the month. The stock price drops to 130 rupees due to some bad news, creating a downtrend. The volume is low, meaning fewer people are selling or buying. 5. Using the graph to decide what to do. Uptrend. Price is going up. If you see the stock price rising over time, it could indicate that it's a good time to buy if you believe the price will continue to rise. Downtrend. Price is going down. If the stock price is falling, it might be a good time to sell if you already own the stock and want to avoid further losses. If you're an investor looking for a discount, you might wait to buy when the price hits a low point. Sideways. Price is stable. If the stock price is fluctuating but staying around the same price, it might be a good time to wait for a clearer trend to develop before making a decision. Summary of key observations on the graph. 1. Uptrend. Look for a rising line. Buy if you think the stock will keep rising. 2nd downtrend. Look for a falling line. Sell if you want to avoid further losses. 3. Sideways movement. Look for a flat line. Wait for more information before making a decision. 4. Volume. Look at the bars below the price line to see how active the market is. 5. Price spikes. Look for sudden changes that might be due to big news or events. Example with a simple graph. Imagine a graph for company ABC. Day 1. Stock price equals 100 rupees. Day 2. Stock price rises to 110 rupees. Day 3. Stock price rises sharply to 130 rupees, a spike. Day 4. Stock price falls to 120 rupees. Based on this, you can see that the stock has experienced a short-term uptrend, but after the spike, there was a small correction. You can decide if you want to buy during the dip, 120 rupees, or wait for further changes.